Joining me now is Charlie Babrinskoy. He's head of the investment group at Ariel Investments. Charlie, it's great to have you. So, yeah, is this going to be the kind of environment where financials and energy can work like they did in the first half? Or am I way ahead of myself in even asking the question, should we still be focused on the downside risks here?
No, you're not ahead of yourself. This is the question, and it is because that interest rates have dropped so much. When interest rates drop, the growth stocks, which earn their money way in the future, become more valuable, at least relative to the value stocks that we love that are making money today. So you're not asking the wrong question. But you are wrong, and the investment community is wrong, if it thinks the bond market has some kind of power to see the future. The bond market has a terrible track record. Over the last 10 years, I think I sent you some numbers. The U.S. equity markets have beaten investment-grade debt by more than 12% per year for the last 10 years. Over the last 100 years, equity markets have beaten the bond market by more than 5% per year. So the bond investor is a bunch of very scared people who, at the whiff of danger, will panic and rush to safety. And that's not the people you want to be taking your ticks from.
All right, Charlie, but let me ask you this. Is it possible that the bond market is calling the shots? In other words, if I think back to the last few years, I think about how many times have we had falling yield scares where what happens? The Fed comes in, they back off of whatever their plans were, and equities rally. So is kind of the missing link in this whole formula the idea that the central bank keeps accommodating these moves by backing off of its tightening plans? And is that about to happen again?
I think that's a reasonable read of history. And there's no doubt that the Fed has bought $8 trillion worth of bonds. They've propped up the bond market at a pace of $120 billion per month. That is going to end. I know I've said that before, and I've been wrong, but they're not going to keep doing this forever. And when they stop, the U.S. 10-year Treasury is going to return to its normal level, which is a return of inflation plus about 1%. We've had Treasury bonds since Alexander Hamilton nationalized states' debts, and in that 200-plus year history, 10-year bonds have averaged 4%, which is their normal level. And I think that's where we're going once the Fed stops manipulating this market.
Shepard Smith here. Thanks for watching CNBC on YouTube.